So that is nothing but decentralized finances, right? So that is the alternative finance ecosystem where consumers transfer, trade, borrow, lend cryptocurrency independently of traditional financial institutions, right? So what are those traditional financial institutions? Those finance agencies, small finance companies, banks, insurance agencies. Without having those central authority, right? Can we will be able to make a system, right, which will be able to perform the same activities, right? Borrowing, lending, insurances, mortgages, all these things can be done through your decentralized applications without any central authority, right? So, and who will play the role? Who will do those activities? That is where your smart contract. Remember what is a smart contract? Those are the lines of code automatically execute whatever you want to do, right? So there is no person who is sitting, okay, I'll give you interest of 4.5%, right? Or I'll give you interest of 5%. So that algorithm, if you write on a code, depending upon the whatever exchange rate, economic policy, if this happens, then the interest rate will be 5% or 6%, right? So there is no central authority, third party who is deciding, okay, I'm SBI, I'll give you only 3.5% interest. Or I am, let's say, Equitas Small Finance Bank, I'll give you interest of 5% or 5.5%, right? So it is not decided by a third party. It is decided by those smart contracts, right? Again, which is based on certain computer lines of code or algorithms, right? And it is executed, can be executed person to person, right? Think about in this way: I have such amount of money, and you want to borrow some money, right? Now what happens? Unless you know me, if you know me, generally what happens? I can go to my friends or relatives whenever money is required, and I'll either borrow or lend money in a certain interest rate, right? But generally what happens? It is in the trusted environment. I cannot go with like somebody whom I do not know and I'll ask money from them, or they cannot come to me and ask money from them, because that is where kind of trust issue is not there, right? So can we build a trustless system? So when I say trustless, that means there is no third party whom we are going to trust. All this trust thing will be taken care by the computer line support, right? So can you build a system where, let's say, if I want to borrow money and I go to bank and bank asks me a lot of documents, 11% is the interest rate, personal finance, 12% personal finances interest rate, but I do not want to give that much interest amount, right? So generally what happens? I'll go to my relatives or friends and take a lower interest rate. Let's say my friends and relatives are not there, or they have already given me loan. I want some additional money to take, additional loan amount. I'm running a business, I want money. So can I go to another person? Let's say you, one of you or some of you have money and you can lend me that money. How will that transaction happen? So the transaction to happen, we can use a blockchain system, and where that lending rate, borrowing rate can be determined automatically, right? Without the involvement of a third party. So directly I can borrow money from you with the help of a blockchain system, right? So that is where interest is. So what happens right now? That person is also getting benefited. So if he charges 8% or 9% interest, so for me also it is better, rather than paying bank 11 or 12% or 13%. I'm getting a interest, or I'm getting a loan amount within a 9% or 8% amount. That person also is getting a benefit, because if he would have put that money in fixed deposit, maximum he would have got an interest rate of 5% or 6%. Now he is getting an interest amount of 8% or 9%, right? So that is where this beneficiary, like people like you and me, are getting benefited when you are taking out the role of a intermediary. Intermediary used to play certain kind of roles. He used to check KYC, know your customer. He used to look through certain documents. He used to be the custodial, right? So you need not have to search for from whom to borrow. You come to me and I'll give you loan amount, whatever money you require, right? So now whatever roles that banks was playing, the third party was playing, now that smart contract or the some lines of code, some algorithm is going to play that role, right? And that is where the basic or gist of a decentralized finance, right? The role of traditional bank finance institutions can be taken by normal, not normal, basically whatever blockchain system we are creating, right? So these are the, again, I'll not get into again details of it. This already you have discussed. one or two key points is in decentralized finances, actually you are not you are still the owner of your money. You know that, okay, I have given a, let's say I have 50,000 rupees or one Bitcoin or zero point 0.5 Ethereum, and I'm giving that on loan, right? You are still the owner of that money, right? But in traditional finance, what happens? Once you give that money, if I say in the fixed deposit, it is right now with the bank. If I'm withdrawing without that 1 year or 6 months, whatever the term period of the fixed deposit, actually I have to give a penalty. From the interest rate, they'll deduct 1% or 1.5%, right? So generally, when I'm putting my money in the bank, bank is holding. So it is just so that, okay, in my account, 10,000, 50,000 rupees is a fixed deposit. But the condition is I am not going to withdraw it for next 6 months or 1 year. If I'm violating that condition, I'll give a penalty, right? Generally, if you withdraw fixed deposit beforehand, you have to, like, the bank will generally charge certain penalties, right? You control where money goes and how it is spent, right? So in the decentralized finances, I can tell that, okay, I want to invest in certain market. I want to, if I want to lend money, I lend money to these kind of individuals. So those are the few things I can control. Or I can control that, okay, I want to earn a interest rate of this 8% or above 9% or 10%. That might be little bit of riskier, but I want to earn an interest rate of 10%. Then only whoever is interested to give me interest rate of 10%, I only will give loan to them. But in bank, I cannot say that. Bank is deciding the what is the interest or fixed deposit rate they are going to give us. I cannot say that, okay, give me interest rate of, so I cannot negotiate with the bank. I cannot say that, okay, I'll keep 50 lakh rupees, 1 crore rupees, give me interest rate of more, 10% or 8%. Whatever their fixed rate of fixed deposit, that only they are going to give me. Obviously, it is faster. Transfer of funds happen in minutes. Sometimes what happens right now also in traditional finances, lot of changes has happened, lot of improvement has happened, but still, like, it is not, there are certain applications, right, where you can get a loan within 6 hours or 8 hours. But if you go to the traditional bank, right, it will take few days, right? If I'm taking a home loan, it is not that today I apply loan and tomorrow I'll get it. For verification of document, it will take a few weeks, right? But obviously it has been better. If I look into last 10 years or 15 years, right, lot of improvement has happened. DeFi is open to anyone. That is one significant aspect, right? Most of the times what happens, if you want to open an account in bank, you need to prove certain, like, identity, you need to prove certain addresses. Sometimes they might ask you the credit, like, how much credit score you have, right? So those are the few challenges in traditional bank. The market are always open, right? And that is where your cryptocurrency exchanges are flourishing, right? Generally, if you look into your traditional share market, they have a holidays, they have a weekend, they have a fixed time, right? But when you talk about crypto markets, right, it is 24/7 into 365, right? You can trade, you can, like, kind of invest in any kind of cryptocurrency if you are using any crypto exchanges, right? It doesn't have a holiday, it doesn't have a kind of a weekends, right? So it is always open. It is built on transparency. Anyone can look into products data, inspect how the system works, right? And that is where, again, one advantage and also challenge is that if people know that how the algorithm works, more intelligent people, more smarter people can hack into the system, right? Can play foul with the system. But less, like, intelligent people like us at least have a trust that, okay, the interest rate is being calculated like this. But the bank is never going to tell us why fixed deposit rate is 5%, why home loan rate is 6.8%, right? So they do not tell us that, right? On what basis they are doing. But if I'm putting my money as a liquidity provider in any kind of decentralized exchanges, that white paper is actually open. If you go to their website, you can actually know that how they're calculating all those percentages, right? Obviously, you have to put little bit of effort to understand it, but again, it is open. But if I go to SBI site, they'll not say that how they're calculating the home loan interest rate or how they are putting a personal interest rate at 11%, 12%, right? So that is the transparency part, right? So the stage one, okay. Up to this, if there are any questions, then anybody has any doubt? Okay. So the first stage, what happened whenever we talked about this decentralized finances, it started basically with a obviously the Bitcoin was the first DeFi system, right? What they told, rather than having this kind of paper currency, we are building our cryptocurrency, Bitcoin, right? Where I can transfer money from anyone to anywhere, right? So that was the first use case, right? Transfer of money, transfer of asset from point A to point B without a third party intermediary. If I own Bitcoin, right, I can send it to anywhere in the world. I do not need a bank, right? I do not need a third party intermediary. But right now, if I want to send my money from my account to my friend's account, you need certain intermediaries, right, who will make those transactions, right? Or if I want to buy certain things, I want to import certain things, I need certain intermediaries, right? So that was the first use case, right? When Bitcoin started, or when Bitcoin use case or the Bitcoin white paper was issued back in 2009, that was the first use case when the people or that algorithm started saying that you need to have a third party, right? If you have a wallet, if you have keeping this cryptocurrency, you can send it to anywhere in the world, right? So that is where the first case, efficient value transfers. You do not need a third party wallet one to anyone, right? So this is the crypto space. The people will keep Bitcoin, Ethereum, any kind of currency, and they can send it to any other kind of individual having a wallet or a private key, public key address, right? Earlier, what used to happen, if I have a payment center, I want to I want to send certain money from my account to another, I need certain financial firms, right? It need to be certain banks through which I can only transfer money, right? So that was the first use case or the stage one. Now what has happened? We are in the stage two, right? So stage one is only the amount of money transfer from one account to another without a third party. Now, if you see, there are lot many things has happened, right? Again, it is a limited thing. Additionally, also we'll discuss certain things. I can do borrowing and lending, right? So earlier what happens? I can transfer money. Now what is happening? If I want to lend money, I have certain cryptocurrencies and I want to lend, I want to earn interest, that can be done. That money, whatever money I have in wallet, there is also like challenge with keeping money in the wallet, right? Somebody can hack into my private key, somebody can take my private key. Or if I'm giving a loan that actually business did not do well and they are not able to return my cryptocurrency, can insurance be done for those specific issues, right? Like you keep money in the bank account, right? What is the insurance? I think most of you know that, right? All of the banks, right? There is always a problem that bank might collapse, right? Like a few banks in the past have collapsed, right? Generally, the rule is for the like most of the banks have that condition mandated by RBI. Up to 1 lakh rupees, 1 lakh or rupees 50,000, your money is insured. That means if I have 5 lakh rupees in a bank and the bank collapses, I will get up to 1 lakh. That is for sure. Above that also I can get back my money if like bank is kind of gets bankrupt and they're selling their asset and they can return my money. But that part 1 lakh amount of money is insured, right? For sure I'll get that 1 lakh money, right? So all of whatever deposits you are keeping on that's why it is safer, it is advisable to keep your money in separate bank accounts rather than keeping all of your money in one bank, right? It might be SBI, right? But that nobody knows which bank will collapse in future, right? There are certain asset management protocols we have discussed that earlier, right? Some real world assets like automobiles, houses, right? Right now what that changing it and the occupancy, the if you will pay certain rent and you can own that asset for a certain amount of time, right? And that use case already we have discussed. There is something called stablecoin we'll discuss. So right now if you see there are we started with only one use case, transfer of money. There are few additional use cases which have happened currently at EPC. Additionally also if you look into future, right, which I have not shown here as the stage 3, right? Lot of use cases are happening in the this cross-border payment, trade finances, right? Trade finances, obviously, we have discussed, right? Where consortium blockchains are being formed, right? Lot of banks are coming together and they are creating a blockchain among them, right? So those are also can be the use cases of this decentralized finances, right? But we'll cover only these 3-4 use cases. I don't want to like kind of burden and because those some part we have already discussed earlier also, right? We'll discuss few of the things, few simpler aspects of decentralized finances, borrowing and lending, decentralized exchanges. Okay, what do you mean by decentralized exchanges, right? So that is where, so just if you go through the word, what do you mean by decentralized? There is no centralized authority. The exchange means if I want to transfer money from one to another, if I want to borrow and lend money, right? Can it be decentralized, right? So decentralized means there is no third party. Centralized means there is a third party, right? So that is the difference. Again, in the blockchain domain also there is a centralized exchanges and decentralized exchanges, right? What we discussed earlier is traditional finances versus decentralized finances, right? In blockchain system also there can be centralized finances and decentralized finances, right? And we will try to like compare what are the differences between two. So borrowing and lending. So this is the like kind of after like first use case happened, right? I can transfer money from one account to other. People started thinking, if I have money, why can't I borrow to third party, right? If I can send money, now what can happen? I can borrow money also, right? I can lend money also, right? And that person will give me interest, right? So that is where the use case of borrowing and lending through decentralized exchanges come into picture, right? DeFi protocols enable the first time to borrow and lend money in large scale between unknown participants, right? Without any intermediaries, right? So that is the major like discussion point, right? Earlier also I can do borrow money, lend money, but I used to take help of finance institutions, banks, right? Can it be done without a bank, right? Rates automatically, okay, set interest rate automatically. We'll see how that interest rate gets set automatically. Moreover, these protocols are truly inclusive, right? And that is the biggest part, right? If you look into 7.2 billion population, around 2 to 3 billion population in world do not have access to normal banking system, right? In remote areas, rural market, still after the internet has penetrated, they might have a mobile phone, they might have a smartphone, but they do not have a bank because some of them do not have a regular job. Some of them do not have a regular like kind of a address. They do not have address proof. They might not have a identity proof. They might not have a regular job or a regular business, which most of the banks will need before they create a savings account or any kind of current account, right? So now the decentralized finances is coming and saying that, okay, if I download that app, that decentralized applications, right? And I want to borrow money or I want to lend money, I do not need a create an account, right? As long as I have my these cryptocurrency wallets, I'll be able to participate in those decentralized applications, right? So that is one big benefit. Then the question comes whether it can be how many use cases has happened. Obviously, if I say in African remote places, whether it has happened, yes, in few states in Ethiopia they have started doing, but what has been the success rate? Till now the success rate has been low, and why it is that we'll discuss that. There are a lot of challenges. Obviously, when you talk about these kind of applications, internet connectivity has to be there. People need to be educated, right? So think about the population who doesn't have a proper education. If I go and talk about blockchain, if I go and talk about decentralized finances, that I can say that, okay, if you want to run a business and you want to like lend 10,000 rupees urgently and you do not have a bank account, you can use this application. But most of them might not be able to use that without proper education, proper guidance, right? So those are the few challenges. Obviously, there is again a user interface issue, what we discussed in the earlier case, because again it is very open. If you look into some Google Pay or a Phone Pay or any kind of this new payment application system, they have a very clear and very kind of visually appealing user interface. It is easy to learn. It is easy to go through all those options and learn how to make a transfer of money, how to kind of hold money, and how to check how much money I have in my account. But it is little difficult when I talk about this decentralized finances. I have to have a private key. I have to keep it hidden whenever I'm logging in. That keywords or key codes need to be there. Then again, like whenever I'm signing in, there has to be a digital signature, right? So these are the technical difficulties, right? And that is where your role might happen, right? If 10 years or 5 years down the line, implementation has to happen. There are people who can build those blockchain or decentralized applications, right? but people need there are the need of people who can understand that technology and can help them simplify it, right? Just imagine a system. If I go to a rural market in Odisha villages, right, farmers are not able to get loan from the bank properly, right? If like harvesting season comes, or the like kind of sowing season comes after 2 or 3 months, most of the farmers still find difficulty, right, to take loans from the banks even after all this kind of prohibiting by the government, right? If I go to a farmer and say that, okay, this is a decentralized finance system, you download this app and you will get a loan. You have to pay this interest rate, right? Somebody need to guide them how that will work, right? How they need to log in, what kind of options, interest rate, how to check that, right? Because it is not like a normal that they're creating a fund, it is not in rupees, right? It has to happen through this kind of uh, monetary mechanisms, right? And that is where the challenge comes, right? People need to, like people like you, who can like kind of bridge the gap which happens between the technology framework and the user requirement, right? People who can understand this technology can interpret it and make a simplified system, right? And that is where most of the use cases fail, right? If you see most of the use cases by the technically kind of excellent, like kind of geniuses, right? They might have a good algorithm, they might have a good system, decentralized finance system, right? But when they create that user interface, right? People won't understand what is a blockchain, right? If I go into a rural market, rural villages in India, and I talk about all these slides, who will understand it? It needs to be a very simplified version where I can say that, okay, why it is helpful, right? What are the things you need to do to borrow money or lend money, right? And that is where the power of blockchain can be harnessed, right? The whenever people like you will be able to bridge the gap. Okay, so some of the key concept what we'll discuss. One of the key concept is yield farming, right? It is interesting. So think about your farmer, like the example I was giving, farming, right? So they grow crops, and whatever crops they grow, based on if the harvest is good, right, and there is a demand in the market, right, they'll earn money, right? So that is the same thing in the crypto space, right? As a lender, if let's say I have certain cryptocurrencies, it is sitting idle at my uh, wallet, or it is sitting idle in the exchanges, right? Obviously there might be, so what I'm looking, the appreciation of asset. Let's say I have some Ethereum, and I'm thinking that, okay, in future Ethereum right now is $4,000 or $5,000. In future it might become like a Bitcoin, and it will become $30,000 or $60,000. That is one way to see it. Other way is to look into the traditional finance system. If I have some cryptocurrency, and some people need those cryptocurrency to buy something or like kind of invest in something, I can give that money to, basically I can lend that cryptocurrency, right? So that is where this all this lending and borrowing comes, right? Lending and borrowing in the crypto space, right? So what will happen as a lender? There are very various DeFi platforms, right? I'll show you certain examples where I can lend money. So I'll deposit my crypto asset, whatever my cryptocurrencies I have, I'll deposit that. These people, what they'll give me certain coupons. So that is basically IOU. That means that is something like a certificate. Okay. So I deposited Ethereum. So they'll give me certain coupons saying that, okay, I have these many coupons, right? So let's say I deposited one Ethereum, and they gave me 100 coupons. Coupons or tokens, the C tokens or coupons they gave. So now what happens? They have Ethereum, they have Bitcoin, they have Stellar, they have ADA. So they have a lot of currencies, right? Whichever person need to borrow it, right? They will borrow from this exchange, they will borrow from this DeFi platform, right? So there are two ways. If they are able to return the money, so they'll return the money. So they'll request loan, they'll lend crypto, they'll repay, right? So they will repay the money like after 3 months, 6 months, the time duration for which they have taken the loan, with the interest rate. That interest rate which has been decided by the algorithm, depending upon the supply and demand. So that is what I was talking about. That interest rate is basically decided by a smart contract or the algorithm, right? So there is no third, like a bank or the bank chairperson or the economist who is deciding, okay, now the economy is better, people will take more loan, so decrease the loan rate, or people are not taking loan, decrease the loan rate, right? People like you need to push money to the market, right? So you need to like if you decrease the interest rate, people will be like kind of come and take loan from you, right? So that is basically a third party used to do, right? So that is right now done by a smart algorithm, right? Smart contract. So whenever borrower sends back the money, right? So that is where you are earning the interest rate. So who is earning the interest rate? There is no third party, right? So it is just a piece computer line support, right? That is a platform, right? So they will distribute money to this lender, right? Whatever interest rate has been agreed upon, right? So they will distribute money to the lender. So whatever returns you are getting, right? So this is a annual percentage yield, right? Per year, annual percentage, if I calculate that, how much yield I am getting, right? So that is nothing but your yield farming. So I have certain crypto assets. I am giving those assets. I am giving those cryptocurrencies. Based on that cryptocurrencies, based on that crypto asset, I am generating certain interest rate. I'm getting certain interest rate, right? So that is nothing but yield farming. Think about in this way. I have certain gold. I'll give that gold to certain banks, and on that gold, I am earning interest rate. Normal case like that, I have gold and silver deposit. So I'll keep that gold and silver deposit to certain bank, and I'll earn interest on that. Same case here. I have Ethereum, Bitcoin, and I'll give it to that decentralized finance platform, and they'll give me that interest rate. And that interest rate is known as yield farming, right? Per annual percentage yield, right? So there are two ways. Borrowers is putting the like interest rate back, and that is how you are gaining interest or earning interest. There might be a situation borrower lost money. So let's say borrower is a trader, and he went on, and that cryptocurrency, whatever he was trading on, that cryptocurrency became zero. Lot of cryptocurrencies in recent like past has value have increased very like kind of high, and suddenly it dropped to zero, right? Market manipulation has happened, and it has become like that. Let's say that borrower is
Just
not a,
recently,
yeah,
Squid Game coin, it
yeah,
scammed
because
everyone and
people start like putting money in that, right? Let's say somebody has taken borrowed Ethereum or borrowed ADA, and bought those Squid Game coin and some like kind of these fake coins, right? And they lost all their money, right? Now what will happen? They will not able to send it back, right? Return the like whatever money they have. So generally to safeguard against that, right? So that might be the case, right? A non-performing asset like in your banks, like Bijay Mallya, Nirav Modi, many cases has happened in India, right? They have taken loan and they are not able to return money, right? So in that case, what happens before this deep like decentralized platform or the smart contracts gives loan to lends crypto to certain individuals, right? They also will ask them to deposit certain assets, right? And that is the interesting part. So a borrower cannot take loan saying that okay, I need Ethereum, right? So what is the collateral? They need to also deposit certain assets. So it can be like earlier what used to happen, it used to be all cryptocurrency, right? But nowadays, many like kind of crypto exchanges are working on. You can deposit your real world assets also. Real world asset like automobiles, your kind of whatever bank asset, gold and silver, or your houses, right? So right now, most of the decentralized exchanges or decentralized finance platform are working on in a system where your real world asset can be tokenized. And let's say I want to like kind of build a blockchain platform, and I need Ethereum token, right? Generally, most of the blockchain or decentralized application platform is run on the Ethereum platform. To run something on the decentralized applications on the Ethereum platform, you need this Ether or the Ethereum coin, right? So I need to lend because I do not have that many Ether or that many like Ethereum, right? So what will happen? But I have, let's say, a vehicle, or I have my house in my name. Banks are there, not there, who will give me loan. So what will happen now? The real world asset can be tokenized, right? My real world asset, whatever my house, whatever vehicle. So there is a way, and many kind of decentralized finances companies are working on that. How to do that, right? That can be tokenized, and that asset I can give my documentation basically as a collateral, and I can take, let's say I want 200 or 100 or 50 ether, right? And I can borrow that ether from the decentralized finances, right? So that is something like many decentralized finance platforms are working. But which has happened actually, which is already existing is, let's say I have Bitcoin, right? I have, let's say, 1 Bitcoin or 2 Bitcoin, right? But I want ether because I need ether to build decentralized applications. Because in Ethereum network, if I want to decentralize applications, I have to pay some charges, pay certain amount of money, and that need to happen on ether, right? So what will happen now? But I have Bitcoin. So one way I can do, I can sell my Bitcoin and convert it to ether, right? So that is one way. I can exchange my Bitcoin to ether. Other way, rather than selling it out, I can make it as a collateral. So what will happen? Let's say I have 1 Bitcoin, I'll give that 1 Bitcoin to a DeFi platform, right? I'll deposit that. Against that 1 Bitcoin, whatever Ethereum exchange rate has there, right? I'll take 20 Ethereum or 10 Ethereum, right? And periodically 3 months, 6 months, whatever has been decided, I'll keep that interest rate. Like, let's say my decentralized application work and I got a lot of investor money. It was a success, right? And after 1 year, I want to return the money. I want to return the Ethereum. So I'll return 20 Ethereum with the interest fee, right? And I'll get back my Bitcoin. So that is the very good use case. And whatever interest I gave, that will go back to those people who have lended Ethereum to that decentralized finances. Let's say 10 of you or 20 of you each have 1 Ethereum. So you have lended to, like, 20 lenders have lended 1 Ethereum each to decentralized finances, this platform. What I'll do as a borrower, I'll keep the collateral, I'll put 1 Bitcoin and I'll take that 20 Ethereum. And on that 20 Ethereum, I'll use that 20 Ethereum and I'll run my decentralized applications. I'll use that Ethereum, right? And if my business is a success, after a few years or after a few months, I'll be able to return that Ethereum with certain interest fee, right? And I'll take back my Bitcoin. And these decentralized, this platform, whatever interest rate they get, let's say they get 1 Ethereum as interest, that 1 Ethereum will be equally divided across your 20 lenders. So each one of you will get 0.05 Ethereum. If you had kept it in your wallet only, it would have only 1 Ethereum only, right? But now what happened? Within 1 year, because you lended it, right? Now you'll get 1.05 Ethereum, right? So that is where the yield farming concept comes. Any question or any doubt in it? And without the intermediary, without a bank. Now also it is actually happening. What we are happening? We are keeping money in the fixed deposit. Bank is giving that to loan to different entities. They are earning interest and they are giving some part of that interest. But in this system, what happens? Whatever interest they get, it is equally divided. Based upon whatever contribution I have made, on that ratio, I get back my money, right? And that is the advantage, right? There is no third party who is eating out my interest rate, right? Any questions or any doubt on this? Other cases,
No,
let's
sir.
say my business failed. I was not able to return the 20 Ethereums, right? Now what will happen? This 1 Bitcoin, whatever the collateral I have given, right? Like normally happens in a bank, right? So they have taken your home or they have taken your vehicle. Like let's say you are not able to pay back the loan. So they'll sold off, they will auction of the whatever the asset you have, right? And whatever the amount of money they are given you on loan with interest rate, they'll keep it. If something is remaining, they'll give it to you, right? And that is how the banking lending mechanism works. Same thing here. I had taken 20 Ethereum as loan. I had given 1 Bitcoin as a collateral. If I'm not able to return anything, see this 1 Bitcoin will be sold off, auctioned off, whatever the that time exchange rate. Whatever money is given, that will be again given back to the lenders, right? Return back to the lenders. So that is again the traditional finances work. So obviously there is a challenge, right? There is a risk associated with it, right? You have lended some money, borrowers too, and that is where this right now, rather than know your customer, so that class exercise is there, go through that on the through certain secondary search. So how decentralized finances, rather than doing this know your customer, moving into know your transaction, KYT. Earlier, right now, most of the banks is working on KYC, know your customer. In decentralized finances, people are moving from know your customer to know your transaction, KYT. So if you see, this is the annual percentage yield, APY. Ethereum, it is very low, 0.01, 0.34. USD coin, it is very high, right? DAI, that is from the MakerDAO, DAI, that is around 2.97 percentage, 4.08 percentage. On this percentage, you are borrowing money. On this percentage, you are earning interest, 2.97 percentage, right? It might look very low for DAI and Ethereum, but there are certain other coins which is giving you a very good interest borrowing rate and deposit rate, right? You will get interest rate of 8.09 percentage, which is much more than your fixed deposits, right? But you need to have this asset as a USD coin, right? If you deposit USD coin, you can get. And can anybody tell why is it so? USD coin DAI have a better interest rate than Ethereum. So this is where the concept of stable coin comes, right? So if you see Ethereum, Bitcoin, any currency you take, and I think some of you gave that example of many fake coins, right? A lot of these meme coins are going and people are investing on the Dogecoin, Cebu coin, right? It might be like if you are investing in a short term, 1 day, 2 day, you are taking out your money. It might look like an intelligent decision, but if you're putting a lot of money on that, right, you might lose that. So that is again like kind of a very riskier aspects of cryptocurrency, right? Lot of fluctuations happen in market, right? So that is where the concept of stable coin generated, right? Where the cryptocurrency is pegged or backed by certain real world asset, like real currency, right? So basically, if you see this DAI, which is from the MakerDAO organization, right? This value is pegged to US dollar, right? One DAI means one US dollar, right? So almost most of your cryptocurrency, they are pegging or they are stabilizing the fluctuations, right? By pegging that currency, pegging that cryptocurrency to the US dollar, right? So that is where if you see the stable coins like USDC, there is something called Ether, DAI. There are few other stable coins also, right? They have a better interest rate because they have a stability, right? They are much more stabler than cryptocurrency like Ethereum, Bitcoin. Bitcoin 6 months back suddenly half 50% is market share or the value was around 50%. Right now again it has come back. Nobody knows what will happen in the future. But advantage of these stable coins are that their value will remain. Obviously it will fluctuate, but it will remain close to the US dollar fluctuations, US dollar, right? So that is the meaning of stable coin. Cryptocurrencies which are pegged to certain stable fiat currencies or real world asset, those are the stable coin, right? We'll discuss in the next slide also a little bit up in detail. So we discussed yield farming. One part of yield farming is this annual percentage yield, APY. Another part is total value logged, right? How much asset. So this is using the app protocol, ABE. There are few protocols on which the decentralized exchanges are working. There is another called compound protocol, which we'll discuss. How much money, how much asset have been logged into that platform, that protocol, right? So if you look into this total value logged, how much value of crypto Ethereum has been logged into this Aave market, how much USD coin, around $2.61 billion, $1.91 billion of DAI, $5.8 billion of Ethereum. So it is not that Ethereum's market share, that is a different thing. So that was in between, that is going to 500 or $300 billion. This is what it shows in this decentralized finance platform, which is using this Aave protocol. So this is basically Aave market. How much cryptocurrency, how much cryptocurrency asset they have in place? Around 5.8 billion of Ethereum, 2.6 billion of USD coin, 1.91 billion of DAI. So again, like there are other 10 or 15 cryptocurrencies. I have not shown it here, right? So if I want to deposit certain USD coin, I'll go, or I want to borrow. I know that what is my deposit interest rate and what is my borrower interest rate, right? And accordingly, I can borrow or deposit, right? I can play two roles, right? I can either, if I have, let's say, USD coin or DAI, I can lend it, or if I require that for trading or some other activities, I can borrow it also, right? So that is where your yield farming comes into picture, or annual percentage yield. Total value locked, or TVL, means how much money, how much crypto assets are in that market, in that platform, right? So that is the total value locked. Any questions on this? So this part already have discussed how these exchanges work. One of the this also is a decentralized autonomous organization, right? There is no central authority, there is no persons who are managing this MakerDAO. MakerDAO actually started as a maker organizations, but right now the protocol is working in such a way that everything will be autonomous, right? So there will be no people, there will be no kind of persons like with authority who will be deciding certain how this MakerDAO organization is going to work. Everything will be autonomous. So that is something which we discuss on the decentralized autonomous organizations, right? So MakerDAO is an example of that. How do they generate money, or how do they operate? Same thing what I just discussed, or the example I said. Borrowers can borrow money, giving certain collateral. Lenders, whoever is lending money, people like me, let's say I have certain Ethereum or some other cryptocurrencies, I can lend that and I can earn interest on that. Whatever borrower is paying interest, I can earn that back. If the borrower is defaulting, is not able to pay, whatever asset he has kept is at collateral, right? That will be auctioned up, and that amount of money will be transferred to me, right? So that is why that is how it is has been successful. But one bigger advantage of MakerDAO is that, so the example what I was giving, right now what happens, most of the decentralized finance platforms, right? If I want to keep collateral, most of them allow some other cryptocurrency, right? If I want to take Ethereum, either I'll give Bitcoin or ADA or Stellar, whatever the pool is there, right? So these are the crypto asset which I am surrendering, which I'm keeping as a collateral to take certain loan. Right now, like I was giving that example, right? MakerDAO is one of the organizations, right, who is working with different companies, right? Where you can, apart from your crypto assets and stable coins, you can also keep real world assets, right? Like your building, automobiles, gold or silver. That also you can keep at collateral and take cryptocurrency as a loan, right? And that is which is the advantage or the differentiation of MakerDAO comes when compared to other like Aave or other protocols, right? So this how that interest rate gets adjusted, we'll discuss in the next part. But just to give an example, DAI is one of the famous stable coin. So again, repeating, what is a stable coin, which is pegged, the value is not volatile like a normal cryptocurrency. Why it is so? Because they are pegged, their value or their exchange rate is pegged or centered around certain real world assets, or real world asset means the real fiat currencies like USD, or it might be euro, right? So that is where that fluctuations is very less. So that is why the name is stable coin. The coin doesn't vary. The value of the coin doesn't vary much. Right? So now we'll discuss about one protocol. We saw one protocol, that is Aave. We'll discuss some protocol called compound protocol. So same thing. I want to lend Ethereum, right? I have Ethereum. What will happen? I'll give my Ethereum to this platform, decentralized finance platform. And some persons who need to borrow Ethereum, they'll borrow Ethereum, right? Whenever I'm putting my Ethereum into this decentralized finance platform, right? So they'll give me some C tokens, right? So that compound tokens are C tokens, depending upon the prevailing exchange rate. Let's say I gave one Ethereum, they gave me 100 C tokens, right? These persons also, whenever they are borrowing money, right, Ethereum, right, whenever they return money, they'll return money in terms of these C tokens, 100 C tokens. So basically this protocol, or this whatever the platform, decentralized finance platform, So what do you mean by C tokens? C tokens are like basically a promissory note. Like, so it is not that, okay, Ethereum, somebody is going to give me certain certificate, right? So it is some tokens, and tokens play the role of kind of a promissory note that, okay, I have deposited 1 Ethereum. So I'll not get a certificate like that. So I'll get a certificate that 1 Ethereum I have deposited, I'll get 100 C tokens or 110 C tokens, right? Whenever interest rate, the borrowers, it is not that a single borrower, single lenders, like the thousands of borrowers or lenders are putting their money, and they are also borrowing or lending their money, right? So parallelly, everything is happening based upon the exchange rate, and how this exchange rate is decided, we'll discuss in the next slide. So what will decide that, okay, if I, so the example I was giving, 1 Bitcoin is how many Ethereum coins, right? How that will be decided. So that is based upon certain protocols and certain rules we'll discuss in the next slide. But before that, how does it happen? Once I deposit Ethereum, I'll get certain compound tokens or C tokens. This person will borrowing this Ethereum, right? Whenever he is returning, he will return those C tokens. And based upon, so if he has taken, let's say, 1 Ethereum or 100 C tokens, interest rate is 5 C tokens or 10% interest rate. Then while returning, he will return 110 C tokens, right? And that interest rate, whatever 10 tokens C token was the interest rate, that will be given back to me. Because if, let's say, only 1 lender and 1 borrower, if there are 10 lenders or 10 people who have lended money, that 10 C tokens will be equally distributed among them. Okay. So let us take a simple example. I deposited 1 Ethereum. Okay. Not 1 Ethereum, that same example I'll give. 20 of you, each one of you have 1 Ethereum each. So you will lend, you will give that to platform, 20 Ethereum to the platform. So for each Ethereum, each one of you got 100 C tokens, right? Now what happens? You have given Ethereum to the CPR, like decentralized finance platform, and you have got 100 C tokens, right? Each one of you have 20 of you who have deposited Ethereum. Each one of you have got 100 C tokens, right? Whenever this person returns, so now the person has taken certain Ethereum. Whenever this person returns with interest rate, so he has taken 20 Ethereum. 20 Ethereum exchange rate that time was per Ethereum 100 C tokens. 20 into 100, 2000 C tokens. On that, let's say 10% interest rate. So while returning, he has to return 2000 plus 200, 2200 C tokens. So he'll return that. So these 200 C tokens are basically your interest rate. So that 200 C tokens will be again distributed among 20 of you, right? So 10 C token each. So now how much value will hold? 100 C token was earlier, now 10 C token, 110 C token. Like that, you will keep accumulating your interest rate. So you keep lending, you will get your interest rate for each month, each year, you will keep getting that C tokens. Let's say after 1 year or 2 years, you want to dispose of, right? So you'll go back to the market and you want to take back your Ethereum. You'll go back to market after 2 years or 3 years. You have 150 C tokens. You'll give that 150 C tokens to the market, to the platform, and prevailing on whatever the exchange rate that time, you'll get back that much Ethereum, right? So that is how it works. So you lend your money, Ethereum or any kind of crypto asset, you earn interest, and again, whenever you want to dispose it of, you will dispose it of, right? So that is how the decentralized exchanges work. Then the question is how that interest rate gets decided, right? Because if you say that there is no economist, there is no Reserve Bank, there is no SBI, ICICI, those chairpersons or the bank managers, those intelligent persons who decide on the interest rate, then who is deciding the interest rate? Who is deciding on the exchange rate, right? So that is where the concept of automated market maker, right? So in the traditional market, so when we talk about this making of market, so making of market means somebody is deciding on that interest rate, somebody is deciding on the yield rate, right? Which is a role of a most of the times central bank. On central bank's repo rate or the whatever the rate they decide, right? On that, banks 0.25 or 0.5% extra they charge, right? Different banks charge different things. So that is most of the times this market maker role played by the central bank. In our case, Reserve Bank. In case of USA, it is Federal Bank, right? But here, when you talk about this decentralized finance, decentralized exchanges, most of the time this is a smart contract or this is a algorithm known as automated market maker, right? So there are different types of market makers, but there are different kind of platforms which use different kind of market makers. One is Uniswap, second is Curve and Balancer. What we'll discuss today is the Uniswap protocol, right? How Uniswap works. You can again get into detail of how Curve and Balancer work. But again, once you understand Uniswap, it is the extension of Curve and Balancer basically are the extension of Uniswap protocol. So let us try to understand through an example. So what generally happens, right? Each AMM means automated market maker. So how much time you have left? Another 6 or 7 minutes quickly. So there are different pools, right? So they will be like in that decentralized finance platform, there will be different pools. So this USD coin, like the example I was giving, that is a stable coin, Ethereum. Then WBTC, Ethereum, DAI, USD coin, right? WBST packs, right? There are different combination of crypto assets or cryptocurrencies, right? So what will happen? Pools are created when someone sends the protocol two assets of equal value, right? So if I want to, let's say I have certain USD and Ethereum, right? I want to participate and I want to like kind of lend my money, right? What will happen? I'll go and equal amount of money I'll deposit here. So that is the point. For example, depositing 1,000 in token and 1,000 in token B creates A by B pool, right? So let's say there is a pool already created, which is USD coin and Ethereum, right? And I have certain USD coin and Ethereum, right? So what will go? I'll deposit equal value, right? Not equal number, equal value of USD and Ether in that pool. So now what will happen? My role will be a liquidity provider, right? So those lenders in a traditional amount, whenever I created a fixed deposit in bank, so I am basically playing a role of a lender, though banks doesn't acknowledge it, but they're taking my money and lending that to somebody else, right? But people borrow money from bank, but generally what happens? I am paying that money to the bank, right? When I keep that fixed deposit. Same thing here. There are different pools which has been created. Whenever I keep that money in that pool, right, I am becoming a liquidity pool provider, right? So this is where the liquidity provider role comes, right? So the person who is depositing money, who is lending money to that crypto platform or to that decentralized finance platform, that person becomes the liquidity provider, right? So let's say I have USD coin and Ethereum, equal amount of $1,000 each, I'll deposit here, right? And I'll get certain tokens, like if it is on the compound protocol, I'll get this C tokens, right? And similarly, those persons who have DAI, USDC, there are like different kind of pools available and you can deposit your money. Somebody wants to take amount certain kind of loan. You need to play, let's say I want to take certain Ethereum, right? I want to use this pool. What will happen? I will deposit certain USDC and I'll take out certain Ethereum. So that is how the borrowing part works, what we discussed earlier, right? Let's say I want certain Ethereum, right? And I have USD coin, right? Then I'll use this pool. I'll deposit USD coin and I'll take out some Ethereum, right? Based on the exchange rate. And that exchange rate will be decided by this automated market maker. So there is a simple formula which Uniswap uses. X and Y multiplication is a constant value, right? So what is X and Y? X and Y is the number of coins what you are putting there, right? So let's say in the start of the exchange, right, the pool is created, 100 A coin and 100 B coins are there, right? And each one of them, let's say the value is $1 each, right? Both of them are stable coin. So let's say this is DAI and this is USDC. Both of them, let's say $1 each. So 100 A coins and 100 B coins. So what is the multiplications of X and Y? 100 multiplied by 100 is 10,000, right? Now what happens whenever somebody is, I want to take, let's say B coin. B coin is in demand. I want to withdraw money. So what will happen? I need to withdraw B from this pool. I have to deposit A, right? So on what ratio I'll deposit? So on ratio the deposit will happen such that the initial multiplication remains same, right? So what will happen? Let's say initial multiplication was what? 100 into 100, because there was 100 A coin, 100 B coin. 100 into 100 was 10,000. If I want to withdraw 20, let's say B, as a trader, I want 20 B coins, right? So what will happen? Now if I withdraw 20, what will happen? Here, how many B coins will be there? 80. So what will be the equivalence? 80 into something has to become 10,000. Then I have to give 25 A coin. Everybody got that? How the formula? It is a very simple formula for Uniswap. Curve and balancer uses little bit of sophisticated formula, but again, it is an extension of this. Fundamentals remain same. They need to keep a balance, right? So that is why the name rebalancer comes. The multiplication of coin, number of coins, quantity of coins remains same, right? So that is the equilibrium. If I want to take 20, like I want to borrow 20 B coins, so how much it will be there? If I withdraw 20, how much B coins will be there? 80. So 80 multiplied by some, because right now it is 100, right? 80 into 100, it is becoming 8,000, which is not the original value, 10,000. So the value need to become 10,000. For that to happen, these number of coins need to increase to 125. Because once it becomes 125, 125 multiplied by 80, then only it will become again 10,000, the original K value, right? Originally, what was the K value? 100 into 100, 10,000. If somebody is withdrawing 20, the B number of coins is becoming 80. For that to happen, you have to deposit 25 pay. So you have to trade 25 pay. So I have to deposit, if I want to borrow 20 B coins, I have to deposit 25 pay coins, right? So that is where the equivalence will come. Then once that happens, now what is the exchange rate happens in the currency? Now I have 125 A coins and 80 B coins. So why that is happening? Because the demand of B increases. Somebody is requiring B, and it could have happened for the A also. If the demand of A was increasing, somebody requires A, they will withdraw A. Once they withdraw A, the value of A increases, right? That is the simple economics logic, right? Supply and demand, right? So now what happens in the pool? Earlier, what used to happen? The exchange rate was 1:1. Now what happens? After this, let's say somebody has borrowed B, new thing is 125 A and 80 B, right? So what will be the exchange rate? For one token B, one coin B, there is 1.56 A, 1:1.56 exchange rate, which was earlier 1.1. So this I gave an example of a 1-to-1, one person only borrowing. Think about thousands of persons borrowing in a same amount of time. The number of coins they will be borrowing will be different. But this algorithm will make sure that the multiplications remain same. The formula remains same. X multiplied by Y remains constant, right? And accordingly, the exchange rate in that pool will be keep changing, right? So that is how they decided on the exchange rate. Is it clear or any doubt?
So, sir, how to calculate the exchange rate, as you have said that the trade is when the 100 B you have taken the 20 B and that is 80 B, then after that, can you say the process after
Okay,
that?
so
Yes, sir.
this pool, let's say originally what will happen, the rule is each will have equal 50-50 percentage. Like Uniswap works basically on the 50-50% ratio. That means A, let's say this is one cryptocurrency A, this is one cryptocurrency B. Each one of them have equal value, not equal quantity, equal value. So we are assuming A is $1, B is also $1, right? Both are stable coins. So $100, $100, right? Now that is there. Now somebody comes, let's say I want to take a loan, right? I want to take a loan from this decentralized finances. I require this B coin. So what will happen? Let's say I require 20 B coin. So I'll take 20 B coin, right? But the rule is
Yes, sir.
once I'm taking 20 Bitcoin, I have to deposit certain A coins. I cannot just take out B coins without depositing any. What I have to deposit? I have to deposit A coin. Now the thing is how much A coin I have to deposit. The formula is the original value equation, X multiplied Y was K. So 100 multiplied by 100, that was 10,000. If I'm taking 20 Bitcoin and I require 20 Bitcoin, what will be the number left? 80 Bitcoin, right? So
Yes, sir,
80
yes.
multiplied by what will be 10,000? In other way, if I ask, so 10,000 divided by 80, that is 125, right? So if I say 80 multiplied by some amount, 80 multiplied by X is 10,000. So X will be what? X is 10,000 divided by 80, that will be 125. So that means this amount of A need to increase to 125. So I have to deposit 25 A. So to take 20 B coins, I have to deposit 25 A. Same thing also happened for A also. If I want to take, so right now this is the situation and I want to take 20 A, I have to deposit 25 B. And how it works? Because the as and when the demand increases of a certain monetary or certain asset, right? The exchange rate, obviously the value of that also will increase. So that is the formula on which it works. So once I take 20 B out of that and I deposit 25 A, now what is the balance? That is 125 A coin and 80 B coin, right? Once as a borrower, I take 20 B coin and I have deposited 25 A coin. So the new pool balance will become what? 125 A and 80 B.
And 80 B, yes.
Then what will be the exchange rate? If I divide by 80 here and 80 here, for one B coin, the rate is 1.50. This means this becomes very valuable. Earlier, what happens? Both are of equal value. Now what happens? For one Bitcoin, the exchange rate is not Bitcoin, one B coin, the exchange rate is 1.56 A coin. Why this happened? Because the demand in the market is for the B coin. The more people borrow B, the value of the B will increase. They'll keep putting A coin, right? And that is where the exchange
Yes.
rate comes.
Sir, then
Yeah.
the new exchange rate, the Bitcoin values, the balance is not same, right? Because for 1B there is 1.56 A, so the balance is changed. Like you have said earlier, that the balance would be same for both the A and B.
Correct, exactly. So that is where that problem, there is something called impermanent loss. So exactly what you told, why that happened and why that with some people. So why this is a loss and why that is impermanent, we'll discuss that.
Sir,
I have, I think, 9:51. Yeah,
sir,
already quiz is on.
as you mentioned, the
Yeah.
every like 1.56 A for 1B,
Hmm.
if there will be a multiple transactions, right? So
Yeah.
every transaction that the interest rate will
No.
change.
So this is a time frame, right? Within 5 minutes or within the fixed time frame, right? Because lot of borrowing kind of, it is not that only one person is borrowing, right? At a fixed time frame, those people who are borrowing, the requirement and the supply demand, the algorithm will be making those calculations. For that time frame, it will decide what is the exchange rate. But after that, again, depending upon the demand and supply, automatically it will be exchange rate will be calculated. So in a fixed time frame for the 3 hours or 2 hours or 1 hour, in that exchange, in that decentralized exchange, the exchange rate will be fixed. Let's say if I want to kind of borrow one, like let's say whatever, B coin or A coin, how much other coin I have to deposit. So was that
Yes,
your
sir, got
question?
it.
Yeah. So
Yes.
it is again that algorithm based upon whichever Uniswap curve or balancer, they will have a time limit. So for that day or for that 6 hours or for that 12 hours, the exchange rate will be fixed. Again, based upon the next supply and demand. So sometimes it might happen that the coin, whatever you are keeping, might lose 20 or 25% of value in short term. We'll discuss that. What is the impermanent loss? We'll discuss that. So please log into, I think the quiz is live. Just give me a moment.
Sir, please do share the quiz link.
Yeah, it is there in the Google Classroom. Just let me know whether you were able to access that.
Oh, yes, sir, got it.
So please, so the starting time is 9:53. So by 10:03, complete your quiz and submit the quiz by 10:04. Okay. So we have not discussed few of the things like Abhijit was mentioning. There is certain impermanent loss we'll discuss and decentralized insurance. So these are the two things which we have not discussed and we'll discuss in the next class. Okay. Chalo, take care.